Hi, Greg Lewis, MetaStock Software. You're about to watch one of the presentations from the 2017 Online Traders Summit. I know you're going to enjoy it. Before we begin, I want to tell you just a little bit about us here at MetaStock. We've been in business for about 30 years. MetaStock is about the most powerful platform you can get for the private trader anywhere. You can test, you can scan, you can forecast, you can customize to your heart's content. It's an amazing piece of trading technology. If you'd like to get a free extended trial of MetaStock, I encourage you to go to metastock.com/traders-summit 3-for-1. That's metastock.com/traders-summit 3-for-1, or just click one of the links provided, and you can get 3 months of MetaStock for the price of one. That's an amazing deal. I encourage you to do so. I know you won't regret it. Please enjoy the presentation and successful trading.
The next speaker is Price Headley. I'm going to say just a few things about him, and then I'm going to get out of the way. So Price is a friend of mine. We developed, him and I sat down, I would say it was probably 8 years ago now. We developed a lot of the methodologies that he teaches in his courses into MetaStock, and he's always been such an upstanding business partner. He's a guy that I will admittedly say I have a lot of respect for. One of the things I like most about Price Headley is kind of the mentality that he brings to the market. And let me explain that to you just briefly. One of the things Price likes to talk about is the ability to kind of stand aside for smaller opportunities in the market. The way he likes to say it is, I'll step over, there's 4,500 optionable stocks right now. I'm happy to step over kind of the smaller opportunities. The research that I do is kind of geared towards finding those larger opportunities that exist in the marketplace. And it's really a good mentality to use. Price has written a number of books. He's been rated by Timer Digest as a top market timer many, many times. And he's overall a great speaker and a very good guy. So, Price, let's go ahead and bring you on here.
Hey, Jeff, how you doing?
I'm good. I can hear you. I just set the screen control over to you.
Okay, great. Let me go ahead and share my screen. Good morning, everybody, and loved hearing what Rob Hoffman had to share. He always has a lot of great stuff, and so it's a pleasure to follow Rob and to be in with you, Jeff, on this Trader Summit. So we're ready to roll, so let's get rolling. You know, I've got a lot that I want to share with you. Jeff alluded to it. You know, I've been trading for about 27 years, and actually Big Trends just celebrated its 18th anniversary here in the middle of this past week. Launched the company back in the middle of November 1999. What's interesting is that, you know, you'd think when you hear the word Big Trends, you think we're just looking for just big, you know, like Jeff alluded to, really monster kind of leverage opportunities. We've got a little bit of something for everybody, but actually, interestingly enough, it is one of the best times that you could ever have right now for getting great leverage. And I'm actually going to also, Jeff, bring in my lead consultant here, Chris Sarah. Let me just upgrade him real quick so he can help answer questions in the chat box while I'm sharing all these concepts with folks today. You know, bottom line is that, you know, we're going to walk through how you can find that kind of leverage. Now, this approach is definitely more aggressive, so it's one of those things you have to kind of be sensible about how you allocate your capital, not get too high or too low, but be really consistent in that. I think you'll definitely enjoy what I have to share with you. And actually, I'm going to share some stuff that Jeff just helped to upgrade our latest Big Trends toolkit with some of the newest material that I've developed that I'll share with you today. Just a reminder, of course, that everything that we're sharing with you here today is for your information and education only. Nothing that we're talking about here should be considered a specific recommendation or buy or sell any particular investment. And of course, you know that you are 100% responsible for your own investment decisions. Big Trends and the staff aren't responsible for any trades you choose to make, and not all Big Trends products and services are appropriate for all types of traders and investors. So always keep your risk level in mind, whatever strategy you're trading. At Big Trends, we don't provide any personalized financial, tax, or legal advice. What I'll share with you today is something where we send out real-time emails and text alerts to your smartphone on our latest signals, and then you decide how you best want to utilize that. Make sure you also talk to your tax advisor before you make any investment that might impact your unique tax situation. It's getting to that end of the year time where and especially with all the tax proposals from Washington, it's definitely going to be a good time to talk with your tax advisor and prepare accordingly. Now, what we want to talk about today, as I said, is really more of the home run approach to options. We call it grand slam options. And as you know, when you think of the baseball analogy, what Jeff alluded to, we're giving up the singles here. We're not going to really focus on trying to just get a small gainer here. That's not where your big leverage is. You know, when you hit a double in your portfolio, you make 100% on your money. That's where we're going to basically target to basically book half of our gains if we can get a plus 100% or doubler. Now, what we do when we can sell half is we create what we call a free trade, and that gives you the opportunity to stretch for more on the rest. Sometimes it's 200%. You can hit that triple on another part of the position. That's where we'll book it if we get that next trade there. You know, some of them get there, some of them don't. We'll talk about how you manage all the trades. And then, of course, when you get a four-bagger, that's actually 300%. So that's our final target is a big 300%. And sometimes we get gaps in our favor, like Microsoft that ended up gapping 756% in our favor. So if we get a windfall gap like that, we'll take the money and run. So we're going to talk about these options cost $1 or less in the way they're quoted, which means controlling 100 shares are going to cost you $100 or less to control 100 shares of stock. And we use a lot of the big name stocks. Jeff alluded to it. You know, I'll share with you some of the stock names we use and a number of examples today. But bottom line is that we take the 4,500 optional stocks down to a list of about 40. So basically, the top 1% of all those optional names that we find in our system work the best for this type of a strong big trend trading approach. We'll talk about theta and gamma and those option Greeks and why you have to be aware of those. We'll talk about some of the indicators that we've developed, and one of the ones I want to focus on is one that Jeff helped me to add into our latest update on the Big Trends toolkit for MetaStock is the Big Trends bands, a new way to see these strong trends as they start to develop. We'll also talk about CCI and ADX and this overall aggressive option strategy. Now, why should you care? I'm always cautious about wanting to talk about big profit numbers, but at the same time, I've got to say, you know, it's been a phenomenal year for the Grand Slam options methodology since the beginning of the year. The portfolio now up over 16 grand in total gross profits here in the middle of November through the end of October, $15,703 in gross profits. That means add up all the profits and losses before commission. So factor your commissions accordingly. Different people have different commission rates. If you're paying too much for commissions, check with Chris Ayer, my lead consultant. He's been with me over 6 years, helps onboard our folks that are new to big trends, and he can point you to brokers that are very attractively priced. Now, the month-by-month results, I don't expect them to be this high of a win rate usually. 90% winners, one losing month there in September in the first 10 months of the year. We're going to have some losing months. I don't want you to expect that, you know, if you get 8 out of 10 or 7 out of 10 or even 6 out of 10 winning months over the next year that you're going to be disappointed, because the reality is we can make a lot more with this strategy than we lose. Every trade involves risk. You could lose what you put into one of these trades because these are cheap options. They're out of the money. They're more aggressive, but we're going to talk about how we manage that. What's interesting is that when we had the September give back after all those nice build-ups through the first 8 months, had the September give back, you think, oh, that's kind of a downer, and then October actually more than made up for that. So you basically took that $3,060 loss and had an extra $800 in gross profit through October, actually up about $800 on closed trades in November as well thus far. That, of course, can change. But bottom line is, why do I think this is such a great opportunity? And so you say, okay, it's a great opportunity here because volatility, as you probably have heard, is at record lows. So CBOE Volatility Index, or VIX, after a little spike during the week where it got up near 14 intraday, middle of the week, settled right back into the 11-ish range. It's been hovering around 10. We actually had a volatility index reading under 9%. What that means, you know, when you look at the volatility, it's been hovering, you know, it's at 10, 11, 12% on average over the course of the last year. The market is pricing for the S&P 500 to move up or down 10, 11, 12% year over year. You know that from the election time last year to now, the S&P is up more than double that. So when you buy an option that's basically priced at half of what it should be, you're getting twice the bang for your buck. And the true big opportunities here are in the big trends. The big uptrends, calls are going to be underpriced. The big downtrends, puts are going to be underpriced. So the reality is when you can find a trend advantage you've got a huge edge on the options pricing model, because the option pricing model assumes that you can't predict the price. So they assume that the price for Apple or Microsoft or Facebook or whatever is going to be the same price a year from now, give or take, that it is right now. We all know that those stocks move a lot more than that. So there's a lot of opportunity here when you can find the trending stocks. Stocks that chop around and go nowhere, I'm not interested in. I want those are stocks that actually are too high price on their options, and you don't get enough bang for your buck on the trends. You've got to have enough trend to overcome for the loss of time. We'll get into time erosion a little bit later. But bottom line is that the analogy of home runs has to go back to the Babe Ruth analogy, because of course he was the leader. They called him the Sultan of Swat, the leader in home runs in his era, 714 career home runs. That record stood until the 1970s when Hank Aaron broke it. But bottom line is that what I think is interesting about this stat is that for 714 career home runs, the Babe had 1,330 career strikeouts, almost twice as many. And you say, yet he was a champion 6 times, technically 7, but he didn't. The first year on the Red Sox, he only had like one at bat. He was originally a pitcher, but because of his skill as a hitter, they switched him over to be, as they call it, the cleanup hitter, in the 4th position, which means that the hope is that you'll get 3 other guys on base and he can hit that grand slam and clean the bases and get a quick 4 runs for yourself. What I love about this quote here by the Babe, I think it's cool. It's got his little signature in there, but basically it says, "Never let the fear of striking out get in your way." So he recognizes up front that he's going to have some misses, some strikeouts. We have to recognize with this approach, when we're taking a more aggressive option buying approach, to say we've got to be willing to not just win, but also willing to lose. And so that's why I say some people don't have the stomach for that, to swing for the fences or strike out. And of course, we're going to try to manage it so we don't have total wipeouts all the time, although occasionally there's going to be a total wipeout. I say that because, for people that, don't realize that going in, I don't want you to come back and say, oh, we didn't tell me the risk that I had in individual positions. There's risk of a total loss in any individual trade with this approach. But I'll share with you, a lot of the individual trades here so you can get some flavor about wins and losses. Bottom line is that it's more of a psychology that I'm trying to get after. Now, that's a pretty scary looking picture here of this 800-pound gorilla. And, that analogy of the 800-pound gorilla in the markets is that the institutions, not you and I as individuals, but the institutions are the 800-pound gorilla that potentially we have to be careful of and also can align ourselves with. It's kind of like if you were an 800-pound gorilla and you wanted to go swimming in a bit of a small pool, you wouldn't jump in and do a cannonball, would you? Because you splash all the water out of the pool. You've got to kind of tiptoe in, ease in, and basically gradually acclimate you and everybody else to the fact that you're entering the pool. If I see that gorilla in the pool, remind me I'm going to be getting out. But basically, the reality is we can actually ride that gorilla's back as long as we recognize what they're after. They're after the same thing you and I are after: more winners and less losers. It's what everybody wants, right? So when you get a big earnings surprise and the stock goes up to the upside bigger than expected, you'll see what I would call prolonged buying, which also is another word for trend, to the upside, uptrend, develop, because these institutions will start buying every dip on those good names. They want to be a part of that good story. Likewise, you assume, oh, they know in advance and they can get in before everybody else and they can get out before everybody else. Not true. Sure, there may be a little bit of leakage on some of that information, but the reality is, and we're kind of count on that because you'll see from these trends like with Microsoft, where the buying interest was strong right before earnings and the stock had a big gap up. Sometimes they just can't get in or out fast enough. And so when you see a big negative report selling, every bounce, you're going to see those stocks dip down. This is why trends develop, because the institutions are prolonged buying on the way up and prolonged selling on every bounce on the way down. So the lesson is, go with the gorilla, go with the earnings surprises, never fight an earnings surprise. If the earnings reaction was negative, even if the news looked great, stay away, because it means that if it can't go up on good news, you're better off to back off and move on to where the institutions are going to want to be piling on. So we want to align ourselves with that. Just some key principles of how you can get an edge in your options buying. I know a lot of people tried to buy options initially and then you failed, and so you gave it up and said, oh, well, maybe selling options is where the opportunity is at. There's opportunity on both sides. As I say, options can be a zero-sum game. The key is, how can you leverage when you're really right on the trends, and the best way to do that is with option buying. This is for part of your portfolio. You can also have option selling strategies for another part of your portfolio. Now, the problem with the options pricing model, the guys that developed the options pricing model, you may remember, it's called the Black-Scholes model. They won the Nobel Prize for it in 1997. And their theory is kind of on the right here. It says that, or I'm sorry, on the left, that basically they're saying that most of the time things should stay close to the about 40% of the time close to the current price of the stock. And as you go out in standard deviations, it's saying those shouldn't be happening very often. The old 100-year flood that should be happening once every 100 years. Well, actually, you can see the two deviation greater tails, as we call them, are a lot fatter, a lot wider, a lot longer and bigger than what's expected in the check mark of what's actually happening. Staying close to the current price is happening quite a bit less. You don't think from 40% down to maybe 33%, 32% that it's that big of a change, but that's kind of a 20% dip in the expected flat type of situations. It's interesting too, if you looked at a normal distribution of the daily S&P 500 return going back over the last we have data since 27. In 100 years, that's supposed to only happen 27 times that the S&P would drop on a daily basis by 3.5% or more. In reality, how often have we had a 3.5% drop? Now more than 100 times since 1927 in the last 90 years. So think about it, 100 versus 27 in even less time, that's like a fourfold edge of bigger than expected moves. Now, we're not just looking for something that's going to happen just 100 times in 90 years. That would only happen just over once a year. We're looking for these situations that can manifest themselves regularly, and so that's why we look at not just one market like the S&P, but actually 40 plus different stocks, so we can get plenty of opportunities in there. But this is a big opportunity, and earnings, of course, are a big part of driving that. And we talk about some of the indicators we use in our Grand Slam options approach. One is the Commodity Channel Index, or CCI. Now, this is one that you can find in your all your platforms. MetaStock's got it, and most of the major platforms have it. If you think Commodity Channel Index, oh, that's just for the futures markets. It's not. Donald Lambert developed this in the beginning of the 80s as a way to try to locate trends in commodities, but I've shown that it works real well on a lot of securities, including stocks and even options charts, which I'll show you about option charts here in a little bit. Basically what we're looking at here is finding the unusual trends. So this key principle here, CCI is a little different than most in that it measures the high plus the low plus the close divided by 3 to get what's called a typical price. So a lot of indicators put too much weight on just the close. And then, you see here that I'm telling you that when something goes quote unquote overbought, and I should put that in quotes, overbought, you hear that word overbought and you think, oh, well, that means it's gone too far. It's got to come back down. I shouldn't buy it. Actually, we found that things that go overbought can stay overbought a lot longer than you expect. And we'll show you some charts in a minute. Bottom line is that, overbought is, I'm laying some groundwork and principles, and then we can get into why we're looking at what we're looking at. Now, oversold, same way. You think oversold, it's already washed out, but some of the biggest crashes happen on oversold situations that just get more and more oversold, from the crash of 87, the Bear Stearns crash and Lehman Brothers crash, to a lot of other names like even recently that we've had, like T-Mobile, I'll show you here in a minute. Now, we also look at the average directional movement, ADX. ADX is another tool that that shows you trend. It shows you when the directional movement lines are starting to pull apart from each other. The positive directional movement means net new highs. Negative directional movement means net new lows. So you're getting a lot of net new highs and no new lows. That's the definition of what? It's the definition of an upward channel. Okay, so you get an upward channel, you're saying we want to be a part of the upside. We don't want to be a part of the downside, right? And so basically ADX measures the percentage trend that we have. So the one that I really want to focus you on today, because Jeff's done such a great job to get this implemented into the Big Trends toolkit, the latest version, is what I call Big Trends bands. Now I developed an indicator called acceleration bands. I still use those too, but those are a little more rare. Big Trends bands will show you some more opportunities of where the percent R indicator, percent range, developed by Larry Williams, will be trending. Now, Larry's indicator usually shows you the kind of overbought, oversold levels, and this is a case where something like Baidu stays very overbought, much longer than you and I would normally expect. I now expect these moves to last longer, but bottom line is that a lot of people assume when it hits overbought right here, oh, it's got to come back down. Big mistake if it keeps going up. That's that 800-pound gorilla, the institutions telling you, hey, it's not the top of the range anymore, folks. It's the breakout to the upside. Now, you see this light blue band I've colored on this chart, and I'll show you some updated MetaStock ones here from recent trades that we made as well, is that it's showing you the breakouts happening here. So we've got the buy signal happening on the first circle breakout, and then you see we're getting that ability to take 100%. Actually, the next day, 200%, a couple days later, 300% after that. Now, you see in this case, we left a little money on the table. It kept going. Why not just ride it all the way? Because sometimes those things can fall out a bit quickly when you get some big news item or whatnot. And so we've learned that bulls and bears can get rich. Let's not be piggish and hogs get slaughtered. So let's manage accordingly. But this is based on the idea that if someone's in the top 20% of its %R readings, the old 80-20 rule, why are 20% controlling 80% of the wealth? Why are 20% of your trades driving 80% of your profits? It's amazing how many ways the 80-20 rule works out, and people say, oh, well, we're at the 1% controlling the wealth now. Well, that's if to the 3 deviations. If you take 80% of the 20, you're basically at the 96.4, and then you take another 80% of that, and you're at the 99.1. They're at the top 1% controlling a good part of the wealth, right? So bottom line is that that's just kind of like keep doing what's working that most people don't expect to happen, and you'll get a huge advantage. Same thing on the way down. We'll show you that. Now, I mentioned, okay, so Broadcom, I wanted to look at, Jeff helped me pull some charts from trades we've just made here recently. This is AVGO as a symbol. Broadcom merged with Avago Technologies, and for whatever reason, they kept the Avago symbol, AVGO. But bottom line is that you see in between our big trends bands, which on MetaStock here are shown in the royal blue lines, you see when it's running right up into this overbought kind of threshold and not getting through there, we're not interested in that because it's not getting past that upper band on a closing basis, and particularly then following through. This next time it closes through there, you can see we're starting to get the breakout, and then we're actually getting the confirmation, which I'll put on a circle on this close. Now, we're never going to be catching the low with this mentality or catching the exact high, but what we're looking for is a significant trend starting to develop. So Broadcom was this was before any of the news of Qualcomm popped out, at least publicly, and bottom line is maybe some people were buying it and that knew something more than anybody else. I don't care about that as long as we get our piece of the action. A lot of times the middle of the trend is the much more consistent end of the trend that we like to trade. Now, what's interesting about this methodology is we do not use a price stop in the first 5 trading days, because what can happen, it actually happened in this case. You see, we're getting in here, and I'm showing you that we're not perfect. Okay, that our signal says it's a good one and it should go to the upside. We're right for a day, and then you see by the second and third day, especially on that intraday third day, whoa, it's kind of intraday, take your breath away. It's kind of spiking down here before it closes back just under where we bought it. You've got to have the ability to not get whipsawed. And what happened is then on that Friday, in this case on the 3rd of November, you got the big spike back up here, and you see that afternoon is where the news is breaking that Broadcom is talking about buying out Qualcomm. And so at that close, we're getting close to our double. We didn't quite get it, but right here, when it spiked up right around 280 that Monday morning, the 6th, not too long ago, Monday before last, we were booking half of our profit at a double. We almost got to a triple, got up to about 150%, but then it started coming back down. You can see as it came back down, we're basically saying, look, when it comes back down, in this case, to a break even, we said we can't afford to let it go past that. So we're getting out here a couple days later as it comes back down. What happened, of course, is then Qualcomm rejected that offer. We're waiting to see if Broadcom comes back out and says they're going to up that offer. But you can see it's a question mark now, because basically it's just tested into the top of this range here. I'm not going to buy it into that resistance until it clears that resistance. And let's face it, there's a binary decision you have to decide whenever you look at a chart. Is that chart trending, or is that chart trading range? What the big trends bands show you here is it's a trading range if it's stuck in between there, versus if we're in the middle of kind of a breakout, get a couple of retests of that band, but it doesn't violate that key low. The last key low there was on this little, it would have closing stop leveled us here just under 260. Didn't happen. Then it spiked up to 280 to let us cash out at a double in the first half. We always sell half at a double, because then you get your money back that you originally put into the trade, and then you can be a lot more loose in your ability to ride that trend. Now, what Jeff also helped me with is starting to implement other indicators like CCI, like ADX, and a lot of other tools into what we call Big Trend Score. And this is another new addition into the Big Trends toolkit for MetaStock here See that laid out on the top left. And we look at it on a scale from plus 100% down to minus 100%. So 0 would be kind of a wash in the indicators, which not surprisingly, when you see it flagging around a 0 line here, guess what? No trend. You see Broadcom's just going basically nowhere over the month of October for the most part until it broke out late in October. You see the green line here is where we're starting to see these things really sync up into a really good trend. You see the first phase happen through these first few days up, and then of course it had that last little spike right up here. Now, just because it's green doesn't mean we should just hold blindly. When we hit our profit objectives, we take part of it off. We'll try to keep riding the rest as appropriate. Okay, but you can see kind of tailed off, and now we're sort of back in this positive but not really that strong enough mode yet. So we're basically not in that play at this point. But we get that window of opportunity, then we cash it in. Now, as I mentioned, some of the Greeks that we want to factor in here, usually for conservative traders, I say buy high delta options. This is a more aggressive strategy, so we're buying a little lower delta. But what we're counting on is that we can pick up deltas fast as those options go from somewhat out of the money to at the money and sometimes then in the money. So the reality is that you will pick up deltas as you're right about the trend. I'm not worried about Vega here because Vega would be an implied volatility change that's usually tied around earnings. I'll share with you the only time I recommend holding an option trade that you own into earnings in just a little bit. There's only one certain setup that makes sense to me. Otherwise, do not hold into and after earnings. It's too risky. But theta is the thing we definitely have to be most concerned about with the strategy. That if you buy options too close to the expiration, you can really get your head handed to you quickly because of the loss of time. Some of you have told me you've bought options before, you were right on the stock, and you still lost money on that particular on that option, and that's frustrating for people. That's where basically you didn't get enough speed of trend to overcome this theta loss of time. Before I show you the time chart, just another example. This was Rand Gold. This is kind of interesting because when we got the signal on Rand Gold here, the stock's trading around $100, and we were buying 110 calls because we can't buy them over $100. And interestingly enough, when it gapped up a couple days later, it was more than 100% gain, so we took half off at 160%. Then a few days after that, it hit to 200%. We took another half of our remaining half, or a quarter of our original investment. And then interestingly enough, in this case, the 300% on the final square there hit right at the high. Now, we don't anticipate that 300% exit is going to be necessarily where the stock peaks. Sometimes that happens, sometimes it doesn't. But we've learned that it's nice to book them gradually as you get profits in hand and then give it a chance on the rest. Now, the time decay curve, you look at this chart and you say, so where should you be at buying options? When you look at the slope of the decay, if you go out 4 months, is basically not that great from 4 to 3 months, 120 to 90 days. So you think, well, I should probably buy 4-month options, right? The problem with that thinking is you pay too much for those options. There's going to be an earnings report tied in there, and so you're going to end up paying for that volatility, and you're going to end up not getting the kind of bang for your buck that you want. We definitely don't want to hold options that have just 2 weeks to go or less. So stay away from buying options in the last 2 weeks of the option's life. You see the slope of that curve is just far too dramatic to overcome. But what we have found is somewhere in the neighborhood of about 6 weeks out, about 40 to 45 days down to, typically, well, usually if it's not working within 5 days, we'll get out. So the first 5-day window, we've got a little time to overcome there, but not bad. You can see the slope of that line is manageable. We can basically expect that even if the trade's not working for us, you're still going to have something left to bail out if it's been flat to against us after 5 trading days. We call that a time stop, and that's where we basically say in that little window of time, that little sliver right there of decay, we're willing to accept as sort of the cost of doing business. If it's working for us, you're going to start picking up gamma. Gamma means you're going to pick up delta, and that means you're going to start seeing more bang for your buck on each successive point. We definitely then will keep riding. Sometimes as these things go from out of the money to in the money, you'll see that you don't really have to worry about the time decay curve anymore because it's trading more and more like the stock. But other times, if it's trading right around the strike price, you still have to worry about this time element. And so a lot of people think, well, gee, since it's 30 days or less, you shouldn't own an option in that window. If it's working for us, we find, as you'll see from the charts, that it can definitely still be very, very effective. So it's really a battle between trend and time, and I'll show you in just a little bit how my option charts really help me to see who's winning that war, and if you buy it, your option chart better be trending up too. Now, you think about some of the popular stocks that we like to trade for Grand Slam options, and it's kind of names that you've heard about, but basically maybe you're not like in the news as much as Apple. Apple is certainly a name that can trend a lot, but the bottom line is that we actually have a FANG service. So I was like, let's diversify our traders and not double them up on more FANG names. But a lot of these names are kind of the next tier of those kind of definitely trend-based stocks. We do have some tech stocks. Alibaba, is just in the news for its Singles Day. We actually took a shot on that, didn't fire, and in 5 days we lost 15%. Okay, you know what? That's just, to me, that's just called take a shot. If it doesn't work, move on out, and it just did not fire. Okay, so that happens. Baidu, I showed you that example where in just 4 days it was up 300%. So gradually booking profit. I showed you Broadcom, AVGO. So you look at, there's some, and Microsoft we're going to show you has actually been our biggest success to date in 2017, because basically the options were cheap headed into earnings. People didn't expect it to gap the way it did, and we were able to book half of our profit beforehand to justify holding that trade into earnings. We'll show you that. NVIDIA, of course, is always in the news these days as kind of the new chip leader. And so that one's certainly another one that deserves to be on the list and has traded well with this mentality. Our favorite gold stock I showed you is Rand Gold, GOLD. It's a little higher dollar stock than most, and you see a lot of these names are fairly high dollar. Schlumberger, one of our favorite oil names, we'll show you that one in a little bit too. And of course, Tesla, been in the news this past week with both their new Semi and their new Roadster. The Roadster, 0 to 100 miles per hour in 1.9 seconds. That almost sounds unbelievable, but yet you can see why that's going to attract some people. Visa, MasterCard, we like the credit card companies. Some of the casino stocks, Vegas Sands and Wynn, a lot of those names are very trending in both directions. And that's what you kind of want with this methodology, is that these growth names, when the market environment is good, they can go up a lot more than you expect. And when the market environment turns south, they can also get tanked fairly quickly and dramatically too. Now, speaking of getting tanked, on the downside, T-Mobile. This is one we called out here just recently at the start of November. And you can see on the chart, we've got some other opportunities back in here where it looks like we're getting some potential sell signals and it's hopping us back out, sell, hop back out. Do you notice that we weren't quite getting all of our indicators really lining up there? While the big trends bands were showing you some very mild breakdowns there where you're saying, okay, well then it didn't work right there. This is why I added in the big trend score, to add in multiple indicators to say, look, when multiple rivers flow together, you will get a lot more power out of that kind of opportunity. That's why you see power plants like in Pittsburgh, where you have 3 rivers flowing together. There's a lot more power there that we can take advantage of. So when this thing started to really roll over here, what's interesting is that we said it had to close under this low to really get going. It did on November 2nd. And then the morning of November the 3rd, there was some news that came out that maybe their deal was back on with Sprint. We were getting in right here, right before the news was announced over the weekend, coming into Monday morning session, that deal was off. The stock went, you can see, from about 59 bucks. We bought 55 strike puts, and so we're pretty far out of the money, but we're going out here into December, so we got some time. And then immediately it goes down to 56 to 55 zone here. So we're booking a double on the first half, didn't quite get our triple. And then what's interesting here is that you say, well, do you hang around and get burned when it snaps back up? Look at what's starting to happen here. That red line is actually starting to disappear here as we're up into this area. So we were out on this next bar right here. We said bye-bye there, just over a week later on the 13th, and said earlier this week, said cannot afford to hold on to that. Good thing, right? Because then it snapped way back up. We would have gotten pummeled on the remainder of our position, giving back those profits and maybe going actually into a loss situation because of the loss of time. If you were sitting on those over the last couple of days. So it's important to know when to be in, when to stay in, and when to no longer want to play the game. You can see, again, this shows you now our big trend score and how things are really starting to accelerate versus kind of a choppier period back here on the left side in October. But then things were, you can see we're starting to get a higher percentage rate picking up here as it starts to break down right here. And CCI and ADX confirmed that. So that's why we said, okay, we want to be short that next morning there on the 3rd. Okay, so again, these can be very quick trades. We send out our alerts in the half hour before the market opens, so we can see where the price of the stock is and say, okay, we've gotten a signal to close the prior bar. Here's what's happening. Here's what we want to buy. In this case, actually, we tried to buy a 57.5 put, but it wouldn't quite trade under $1 on that bounce on the hype of that initial, maybe the deal's back on that morning of the 3rd. So then we flipped it down and said, let's make sure we get on board, and we switched it down to a 55 put instead. We got in for, I think, about 70 cents, $70 a contract. Controlling 100 shares of stock, then when the stock's trading at 59, that's $5,900. You buy you control $5,900 of stock for $70. That's what? That's about 80 to 1, 80 plus to 1 leverage, right? So that's why the quick pop down of the stock of about, you can see maybe 6 or 7% is leading to a real nice juicy gain for us on that put. Another put example, this is Schlumberger. I mentioned the oils. The oils have been pretty rough this year until the last couple months. But bottom line is that the big opportunity in this chart, and shows you CCI as well as ADX, everything's starting to line up right in here as things were starting to really pop there back in late April. And you can see it's just this first little hard quick down after that sell signal that's actually allowing us to book this for a 100 and a 200% gain, and then the last piece, it didn't fire, started to come back up, and we were out of the last piece at like would have trailed to about plus 100, but basically it got filled at plus 67. Okay, so it's one of those things where, you know, sometimes that happens too. You know, so you look at this and you say, you know, how does that end up looking? For example, if we look at a spreadsheet, you can see it here, and I'll show you the updated results here in a minute. But you can see, you can also email us too over at clientcare@bigtrends.com. We can send you this full sheet so you can study it in detail, line by line here. But you see, there's the double in just about a week on Schlumberger on the May 73 puts. There's the triple a couple days after that as of May 4th, and then by May 5th, it was already flipping hard again, since we're basically saying, okay, protect that last piece, don't give it all the way back up, and you can see it ends up being a nice, still healthy return even on that final piece. So more recently, you see it was trying to break down, then it snapped back up. So bottom line is that, you know, there's times to be in, there's times not to. Tesla, I mentioned earlier. Interestingly enough, this first move, we got the signal, and then when we tried to get in, it gapped up, and we couldn't participate on that first gap. So what we do in that kind of a case is we buy into a retest. There's a %R retest right there with the big trends bands in white on this black background here, and you can see it looks like it should do okay going back up here through this phase, but you know what? It was too slow, and that one ended up being a total wipeout. Okay, I mention that because then if you panic and you don't take the next trade when everything lines up here, getting the buy signal, you would miss this end of May, beginning of June phase, where then Tesla, you can see, goes 100, 200, and 300%. How long did that take? On that spreadsheet, you can see it went from May 31st buy at $1 on the July 435 call. It's well out of the money, but we had plenty of time there. You can see like a month and a half of time. That's into that sweet spot of about 6 weeks out before expiration. That in a week it was doubling. The day after that it was tripling. The final piece happened about 2 weeks into the trade from May 31st to June 14th. Now, if you held on after June 14th, the middle of June right here, you see it's about at the peak, right? It goes up a little bit more and then it tanks off. If you see it tank off here, it's too late. You're going to give up way too much of your profit if you're selling at the official trend violation there. Okay, so we like to book profits as the market makes them available to us. Now, I mentioned option charts. This is something that nobody else is talking about, and I'm shocked that, you know, basically if you're trading options, why would you only look at a stock chart? I've had very well-known option strategists who tell me, why would you buy looking at an option chart? It's just a derivative of the stock. I'm like, don't you realize that there are other factors that price an option besides just the stock price? It's also got the time component factored in and how much volatility you have to pay for that time. If it's got earnings coming up, you know that those options get juiced up. So we need to look at the options charts too to say, is the option moving? This is back to helping save you from those options you buy where you think you found a good stock, the stock grinds slowly higher and your option goes slowly lower or quicker than slowly lower. So time decay is something we've got to manage. Now I wanted to show you this chart on Microsoft because here's a case where you say, oh look, back in September it broke out of your big trends bands and that trade didn't work. And I say actually a couple times there where it broke out, failed. And you see that there's no green underneath that chart because our trend score was not getting bullish enough, and certainly CCI and ADX weren't confirming that as well. You see on this next phase, as the breakout happens back there at the start of October and then it confirms on the 9th, that was a confirmed signal for CCI and ADX as well. And you can see then the other indicators all came on soon after that too. We were able to book a nice double there in about a week on Mr. Softy, and that's my only way that I will hold this trade into earnings. So we didn't quite get our triple target. It got to about maybe 160%. So we're still sitting there the day before earnings. The stock's trading about $79 at the close the day before the earnings in late October. We owned a Microsoft 80 strike call, and when it gapped up and opened at 84.30 and change here, we were able to see those options go up to $4.71. We bought them for 55 cents, $55 a contract, then worth $471. That was a 756% gain. So at that open, we're saying, thank you very much, cash out the rest because it's beyond our 200 and 300% objectives. We did take half out of the double, and that's what allowed us to have that free trade. You can see, sure, the green lasted all the way here until you can see the start of this week. But basically, I've already made my profit objectives. Why should I continue to hold that? You see, it didn't end up doing anything. Could have kept going up, could have gone back down. Who knows what it could have done? But the reality is we took that money and said, thank you very much, check mark, book the profits, Dano, book them and run. And you can see on the options chart, here's the November 80 call. We bought that when the stock was trading around 76 1/3, back there on the 12th. Okay, so we're getting in there at 55 cents. And you see for about a week, even though the stock's moving up, the option's not doing quite as much as we thought it would at first. But the indicator still looked net positive on the option chart as well as the stock chart. I'll show you another option chart in a minute with a nice intraday read. But we're booking the double in that first half there. That's our plus 100 right there on this first piece. Okay, so we're saying, okay, once you can get 100% out of a trade, you basically have your risk capital back in your pocket. That should allow you the ability, if you have an event like earnings, to free roll in front of that, assuming the indicators are still good. You see, percent R actually came in for a retest here right before, and we kind of just held. We tested, but held that kind of percent R support, and then took off. So that shows our big trends band there as well. Kind of crunch time held, and then the big gap up to 471 on the option. So at that point off the open, it went to $6 intraday. I don't care anymore. I've got 756 on my second half of my position. That the combined position was up 428% because you got to add those two and then divide by 2 to get your combined growth. Now, Goldman Sachs, here's a Goldman Sachs chart as well. You see that percent R was there first. Percent R had already broken out back here. But you know what? We had to see the other ones come on board. You say, well, gee, aren't you leaving money on the table? And what I'm saying is I'm preferring to see that we're getting everything lining up. So at that close, next bar's open, we're getting in here. You can see from that point, 4 days later, we're making 100%. And then we hit the break-even trail on the rest after the 7 trading day. We're done with the trade. I thought it would have kept going. It didn't. And that's the thing. You can have a belief that something's going to happen, but if the market charts don't support it, there's no point in you hanging around on that. Okay, so the bottom line here is that here's an intraday options chart of Goldman. This was the November 260 calls, and you can see here that we've got the percent R, the big trends bands working great on a 30-minute basis. We come in for our retest on that little spike, and then it flips right back up. You see the next retest is coming in here, gets violated once we shoot down below there. This was actually at about $1.60 on the intraday chart. Would have been an even better exit than when we took it out at a break even. But the intraday charts, of course, have a little bit more noise. But the bottom line is that, of course, we booked it when we hit $2 right there. So we're saying thanks very much, took our half of our trade, and then we're selling the rest, trying to give it some room to bounce back. Never happens. Sell the rest out at break even. We made 50% on that trade combined. Okay, so and as we'll get into just recapping the past month's trades here in just a sec too, but just the basic premise here is we're getting that gamma boost from these more aggressive out-of-the-money options. We also have found that even when you're wrong, they'll hold on to some value. So if you've got a month left, they're not going to nothing, even if it's going against you. So you got something that you can salvage, and I'll do a quick walkthrough on the track record here in a minute. The option charts, I believe, give us a huge edge. And like I said, 40 or just over 40 stocks means we're in the top 1%. I want to be in the top 1% of the best moves. I don't want to try to trade every little move that comes around because it'll reduce your confidence to not be around for the big moves if you get chopped around by less clear trends. Okay, so get everything in your favor. It's a lot more powerful potentially. Steve says, why not just sell puts? You could sell puts and make a little bit of money. this approach is for people that want to get some serious growth into their portfolio. That we do put credit spreads and other services for on the S&P and things like that for real slow, steady, high consistency kind of stuff. But for people that want to get the kind of growth potential we're talking about, you need to buy options to have theoretically unlimited upside, or certainly many multiples of what your risk is. From this perspective, we've got to have a catalyst. Usually it's earnings or some kind of a pending news on a product or some other thing that's coming up, but sometimes it's just a technical breakout, and that's fine too. It means that, hey, you and I are like other traders. We all see something happening. Everybody wants to participate, assuming that my indicators are confirming it. I do too. These are out of the money options going out, like I said, 4 to 6 weeks, and from the starting point here, and buy them for $1 or less. If I look at an option that I think should be priced at $1 and it's at $1.50, and I really like that stock, I'm going to end up going to the next strike up to basically on a call to say, okay, I need to pay less than that $1 or less. So $100 per contract or less. Our model portfolio is based on $1,000 or less going into each trade, and we'll never hold more than 5 trades open at once. Usually 2 to 3 trades at once. So basically, you can potentially do this with even a smaller account than what we show here, as you'll see in a minute on a model portfolio. Gamma is where you can really hit your home runs, and you really see that delta effect really pick up as you catch that stock move correctly. The time stop has really helped us too, because I say don't put an initial price stop in there and get whipsawed, because we are buying typically breakouts, so you might have some retracements along the way. And what I found is that if you just wait for retracements, you're going to be left at the starting gate way behind on moves that never look back. So we tested both sides and felt that it was much better to, the number shows much better to get on board and then just not get whipsawed in the first 5 trading days. Now we notice that after 5 trading days, couple things. If it's not working, if it's flat or against us, time is starting to really eat into you in addition to price movement not helping you. So that theta is overcoming that gamma effect that we're looking for. So we don't want that to happen. As I said, book windfall gains at plus 100 on half, 200 on another original quarter, or half the remaining half, final 300% on the final part. And don't overcommit your capital. We tend to recommend 5 to no more than 10% of the capital going into each trade of the money you allocate to the service. We're not talking about your whole portfolio, just so the money you allocate to the service. So we're using a model portfolio of 10 grand and basically only putting $1,000 in per trade fixed. So as the portfolio grows, we're putting in $1,000 a trade. That's actually less than 10% now. It's actually below 5 now. The portfolio is up to from 10 to 26,000 plus in looking at a gross basis before commissions. Factor your commissions accordingly. Everybody's commissions are different. And like I said, how have we done? You see the first 10 months of the year, like I said, I don't expect to do 90% winning months. I don't need to with this approach, as long as I can control my risk when it's not working and let the winners run on at least part. When it is, you can see that it can add up real quickly. And you say, well, how have we done in the last month here? Well, basically, if you look at from the start of October here, this is the total portfolio. You can email us, like I said, clientcare@bigtrends.com, and we'll send you this full results. You can study it. But from the last trade at the end of October, 25,631. Now with all closed trades in November, 26,435. So up about $814 in gross profits. And you can see the trades we've had. There's AVGO. We showed you that 100, then break even on the rest. I mentioned Alibaba didn't fire, so we got out after the 5 trading days. Ended $1 out at 85 cents, losing 15%. On the 10 lot. And then you see T-Mobile, we got the double on the first half and went a little higher than 150% on the remainder. Didn't get to 200, so we trailed our stop when it wasn't firing. We were out a week later on the second piece and still got 57% before, if that would have been a give back if we had held on here. So that was good that we got out of that and preserved profits. And Starbucks looked like it was starting to fire, and then it started backing off. We lost 36%. So even with all the wins and losses added up, you can see, okay, $800. That's not our biggest month. We still have a couple more weeks to go in this one, and a couple of open trades you could get into as a new subscriber right now that we think have some good potential over the next week to 2 weeks as well. So let's show you what you can do to take advantage of this, and then we'll come back in and answering questions, and then hand it back over to Jeff in a minute here. Usually this is a couple grand a year for a 12-month access. And so usually for a month you'd pay $199, but what I'm going to do, because Jeff and MetaStock's crew has been so good to me, is basically say, I'm going to allow you to try it for the next 30 days for 99 bucks, and then if you like it, it'll just auto bill every 30 days. You don't have to lift a finger. If you don't like it, you can call us or email us and cancel it at any time if it's not for you. So over the next month, we promise at least 6 trades. Like I showed you, we've actually had more than that so far, looking back over the past 30 days. But the bottom line is that we're expecting that that'll be about the average frequency. We're not committing too much into any one trade. So even after a good run, I don't want you getting too high and loading up or doubling down. And if we have some givebacks, I don't want you giving up either. I want you to be kind of taking a slow, steady amount that you can say, okay, let's see what we can do for you here over the next 30 days. And if you like it, as I think you will, you'll want to stick with it. It'll just auto bill after 30 days. If you don't, just tell us, we'll cancel it. So what's also great about that is that, like Jeff mentioned, while these prices are too low and that price will go up in 2018, the bottom line is that I'm going to honor it for you month after month. If you like it, I'll continue to just keep it at 99 bucks. It will not raise on you if you lock it in here today. So this is kind of a way to kind of beat a future price increase by locking it in at basically half off the normal monthly rate before the prices jump. So obviously with the kind of results we've been able to generate, we've had a tremendous amount of interest. We can't keep it out there for too long, so make sure you take advantage of it quickly, because at some point we won't want to have too many people in the service, and so we're very sensitive to monitoring that and making sure that we're not moving too many contracts around that would cause us a problem getting in or out. We're not there yet, but not far from that as it relates to making sure that you take advantage of it quickly and get on board the Grand Slam options approach. You see the link Chris has posted for you on your chat box at bigtrends.com/GSO for Grand Slam options. And when you go to that page, actually I didn't pull that page up, but I should. On that page real quickly here, bigtrends.com/GSO, you'll see it's really simple. It's basically, I feel like I have to show it because sometimes we always get questions of things that I think are simple, but sometimes people have questions on. You see, it's just one simple action point. Hit the add to cart button. Like I said, it's a 30 days at a time auto renew. If you don't like it, we give you the clear instructions on how to cancel it through email or call us at any time. So just click on that button. We've already taken the coupon down $100 for you from the usual $199 to $99. Green checkout button, you hit that, and then it just goes to our secure page to allow you to put your key information in bold to let your credit card process. And if you want to get text alerts to your smartphone, type them in the shipping note or customer note here, text alerts to whatever your number is, and tell us after you type in your number if it's AT&T or if it's Verizon or whatever it is, because we put those text numbers on the appropriate list so that they can go out quickly as a batch file. We list all our terms and conditions real specifically for you. Once you reviewed that, including this special piece on automated renewal programs, which is what this is for simplicity for you and for us, then it's real clear, and the cancellation policy is real clear there as well, kind of broken that out. But we encourage you to read the whole terms and conditions. We're real transparent. Once you do that, click on the box, once you got your credit card information, all that in there, hit the submit order button. You should be good to go. John says, what stocks do we use for the service? We use a lot of the big name trending names. So I mentioned names like Alibaba, Broadcom, Baidu within the tech sector. We like the credit card names like Visa and MasterCard, to name a couple. We like casino stocks like Vegas Sands and Wynn Resorts, and then we also have like Randgold Resources, GOLD, Schlumberger, SLB within gold and oil. We try to get some sector exposure across all the major names, so that way we feel like if a sector's moving, we're going to get a piece of it with one of those leading stocks on the way up or on the way down. So like I showed you, it's not just an upside play. In a bull market, obviously we've had more calls than puts, but we had some good puts as well, like I showed you with T-Mobile just here in the past couple of weeks, and also Schlumberger. But bottom line is that we'll stay flexible, and that's a big part of it for us as well. I want to give Jeff some time to tell you about the Big Trends Toolkit, so I'm going to go ahead and hand it back over to him. If you have other questions, definitely call us toll free at our 800 Big Trends number. You'll see at the top right of that order page that I just mentioned to you there, very top right, our toll free number. But just remember 1-800 Big Trends. You can reach us toll free, or you can email us anytime through clientcare@bigtrends.com. Back over to you, Jeff, and thanks so much for including me. I know we've got a lot of other great speakers, so people want to stay tuned for this awesome marathon trader education event.
My unmute button disappeared momentarily. Thanks, Bryce. How's everybody enjoying the class today? I'm curious to get any feedback that you've got. Bryce, great presentation. I thought it was awesome. I can't speak for everybody here today, but I thought it was great. Thank you for your time today. I do want to talk just a little bit, and we don't really have a lot of time. Thanks, Lib says it's great. We don't have a lot of time to kind of go through this, but we did, like I said, several years ago, we created the Price Headley Big Trend Toolkit for MetaStock, and it has been insanely popular as an add-on for MetaStock, and that's probably why we're on version 3. Version 3 just launched, just barely. I think it launched like September or October. It's a major revision to all of the stuff that we've done in the past. Went in and out a lot of scoring methodologies. The thing I like about Big Trend Toolkit is it is a fairly massive toolkit. It has a lot of indicators, a lot of different systems and methods that Price has developed and worked on over the years. But it all goes back to that core concept I was talking about, is identifying kind of those best opportunities. In total, and we certainly won't have a lot of time to talk about much of this today, but I will be doing a special session on all of the add-ons to kind of talk about them next week, to kind of go through them in a little bit more detail. So I hope you can make that. In total, it's got probably about 20 different indicators and about 16 or 17 different methods, including a new scoring method that he talked about, as well as a new big trend bands that he also talked about. And each of these methods are testable in MetaStock, which means you can go in and test them against the stocks or the optional stocks you're interested in and get good feedback on terms of which stocks work best for them and that kind of stuff. One of the things that I like about the Big Trend Toolkit, to kind of talk about it from a really high level, is the level of commentary that's actually included in the methodology or system. So in it, when you apply a method to one of your favorite stocks, it's going to tell you specifically what you should be looking to buy, whether that's the stock or the options, what expirations you should be looking for, if you're aggressive, where you should look for your strikes, if you're conservative, where you should look at your strikes. And in addition to that, exactly and precisely the exit definitions for when you should get out of the market. Really does a great job of taking kind of these methodologies that Price has been using for, I think, over 20 years. I should keep track, and kind of boiling them into a product that kind of combines all of the research that's available into this from this top market trader. It also includes scanning, so you can go through and take your favorite systems and scan all of the optional stocks. Or if you're not in America and you want to trade London, you can scan LSE stocks, whatever it happens to be that you're interested in, and find the opportunities as they exist today. So in a nutshell, it does scanning. It does our expert advisor, which gives you the alerts. It gives you the buy signal. More importantly, it gives you the advice, and it does have full-blown system testing. So you can go in and test the trading ideas, see how well they work, see what stocks they're working best with right now, and really narrow down to what method you want to use with what system that you want to use. We're out of time. So in any case, this all of this is available at a fairly cheap price. It's $49 a month or $4.95 a year. It's a very, very all-inclusive toolbox from one of the top market timers out there. So 49 bucks a month, $4.95 a year. If you have questions, if you want to get some more videos on it, give us a call, 800-882-3040, or visit us online at metastock.com/saleschat. And don't forget about the Trader's Toolbox. It offers all of the add-ons that we're focusing today, in addition to 2 years of stocks and commodities, special bootcamp class that I'm running on December 7th at 6 p.m. Eastern Time, training to help you get started. It allows you to try really some of my favorite add-ons with a product that's been literally rated #1 every single year since like 1994. It's incredible. Normally, if you bought all this separately, it would cost you about $3,000. You can buy it here at the Summit for $15.99. Again, we're out of time. 800-882-3040. I do notice that there's chats coming in. Yes, you can use this in India. as well. We cover roughly about 90% of the total global market cap, over 400,000 issues on over about 200 exchanges. So if you have questions, if you want to get some more information, call us 800-882-3040 or visit us online at metastock.com/saleschat. Another shout out to Stocks and Commodities magazine, 17,000 articles, over 1 million subscribers, have been publishing nonstop consistently since 1982. It's a great magazine, and we really appreciate their sponsoring our summits. Again, they've been summit sponsors since the very, very first one. Who's next, TJ asked? Well, the next person, and if you just want to try out MetaStock, again, it's been rated #1 25 years in a row. There's a few of the things that I like to do. I like to talk about, its ability to scan and test and forecast and get commentary and signals and alerts. Dude, it starts at $59 a month. We're offering a special. If you just want to try out MetaStock, see what all the hype is about, go to metastock.com/tradersummit, Traders-Summit 3-for-1, and you can pay $59, have access to MetaStock until February of next year. 3 months for the price of one, basically.